The entire system is built on credit, on leverage. So if credit and leverage become expensive all of a sudden, then clearly you're going to make some damage. I mean, that's undeniable. Now, this is a problem. This is a bad model from Silicon Valley Bank. I mean, very volatile funding base, terrible risk management. This was the perfect storm. I mean, guys, I cannot stress how irresponsible this is.
Alf, thank you so much for joining us. It's great to see you.
Hey, Robert, Brendan, thanks for having me.
You have done great work, both on the micro level and the macro level. Last weekend was a highlight for me in looking at your work because you did such a great deep dive. I thought the best one on Silicon Valley Bank. And I thought maybe we would start there and then start talking about the implications of the regional banks and of the overall banking system in the US. And now, of course, Europe today seems to be feeling the pain. And we can talk kind of about where this is all taking us and what are the implications for the market. So take it away.
Robert, Brendan, can I share my screen by any chance?
Absolutely.
That'd be awesome.
Because some slides I think will probably help. All right, let's do that. Can you see the screen?
Yep,
Yes.
looks good.
There you go. All right, so a Silicon Valley Bank. One liner is the following: a terribly mismanaged bank that used regulatory and accounting loopholes, which are not actually, how can I say, only relevant for Silicon Valley Bank. They are there to be used, and I think the US has to fix those. Silicon Valley Bank and other banks have used those, and now we see the consequences. So this is the one-liner. If you want to see what happened, instead of talking about the securities book, we should first talk about the funding of Silicon Valley Bank, the liability side of the balance sheet. In this chart, you see how Silicon Valley Bank here had only less than 10% in their deposits from mom and pop sticky deposits. Only 10%. It's a higher risk deposit base. And why? Because if you have only high ticket flying tech founder depositors, they can fly away very, very rapidly. One regulatory failure. Let's start by introducing the fact that Silicon Valley Bank is a bank with below $250 billion in assets. That makes Silicon Valley Bank exempt from two extremely important regulatory constraints that large banks instead have to adhere to. The first one is the net stable funding ratio. The net stable funding ratio is a rule that regulators put on to force banks to have sticky funding on their balance sheet. Be it long-term bonds they issue at the market, be it a large amount of mom and pop retail deposits, very diversified. They are unlikely to dry up your funding very rapidly all at once. Silicon Valley Bank didn't have to adhere to this rule, and that's why they could have so little of these mom and pop sticky deposits and no long-term bond funding on the market. None of it. It was all potentially runaway deposits. So that was one big problem. The second problem with Silicon Valley Bank was the asset side. Why do banks buy all these bonds in the first place? They buy it for two reasons: to make money, well, it's a bank after all, and to meet regulatory requirements. The liquidity coverage ratio is another rule that applies to large US banks above $250 billion, where the regulators basically say, hey, you need to have as many high-quality liquid assets to meet a situation where your deposits fly away very rapidly over a 30-day period. And that's the liquidity coverage ratio. You need to have enough liquid assets to meet these cash outflows over 30 days. What are these high-quality liquid assets? Well, bank reserves. If you have money at the Fed, that makes sense. You just take it out and you pay your depositors. Done. That's the most liquid stuff you can have. But also regulators said, well, you can also have securities from sovereigns. That's treasuries. You can have treasuries. We will treat them exactly as they were cash from a liquidity perspective. Then you can have maximum 40% in actually much less liquid and much more risky stuff. Corporate bonds, RMBS, so residential mortgage-backed securities, etc. Now, second problem, Silicon Valley Bank, being below $250 billion, didn't have to meet this ratio, which means they bought bonds, but they didn't respect these ratios. They had a huge amount of mortgage-backed securities, way over 40%. They had $90 billion of RMBS on a 200 billion balance sheet book. That's a gigantic amount of RMBS. If they would stick to this regulation, they would have had maybe about 10 billion. Did I give you the sense of how bad this was? This was 9 to 10 times more what they would be allowed if they were subject to this regulation. If they were subject to the net stable funding ratio, they could have never had this risky deposit base in the first place. So you can understand that banks below $250 billion in the US are subject to much less regulation. That makes them more prone to take risks and do a worse risk management. Let's talk about that for a second. Risk management. If you have a 90 billion residential mortgage-backed securities portfolio, gigantic compared to your balance sheet size, you can still try to manage that if you hedge your risks properly. Bonds have two types of risks: interest rate risk and credit risk. Now, the credit risk is tricky to hedge. You need to do credit default swaps, and in some cases, banks actually are fine with credit risk. They make loans to the economy, so they're okay taking credit risk. But interest rate risk on a securities book, normally you need to hedge that. How do you do that? You do that with swaps. So you buy a bond, and then you take a derivative that hedges away your interest rate risk. Let's have a look at Silicon Valley Bank. They had a 120 billion book, of which 90 billion were mortgage-backed securities. This is huge. And then the duration, so the interest rate sensitivity of this portfolio was 5.6 years. After hedges, the sensitivities of the portfolio was 5.6 years, which is another way to say there were no freaking hedges in place. I mean, guys, I cannot stress how irresponsible this is. I'm going to say one last thing to make you understand the accounting arbitrage that US banks can use, or actually can use. They use because this is the structure. Notice this is valid as well for large banks. So now we are extending a bit the spectrum. Large banks are subject to tight regulation. They cannot have all that residential mortgage-backed securities on their balance sheet. They cannot have a funding base so concentrated, but they can use these accounting tricks. If, as a US bank, you buy a bond and you put it in an accounting classification called held to maturity, this is what's going to happen. The price wings in these bonds, they will appear not in your P&L, not in your capital position. So you basically buy the bonds, put them there, forget about it. Whatever happens, if interest rates implode, nothing happens to your financials. No P&L drawdown, no capital drawdown, nothing. So very convenient, very convenient. But these bonds booked in held to maturity, which Silicon Valley Bank had a lot of, they still run economic risks, right? I mean, if interest rate moves, you can close your eyes and pretend that nothing is happening, but it is happening, right? You're losing economical value on these bonds. Normally, you hedge them with swaps. But the regulator says in the US that if you book a bond in held to maturity, you are not supposed to hedge it. That's what they literally says. The notion of hedging the interest rate risk in a security classified as held to maturity is inconsistent with the held to maturity classification. So they're basically saying, well, buy a bunch of bonds, put them in held to maturity, forget about them, forget about your running economic risks, don't hedge them. If you want to hedge and buy a swap, I am not going to give you some accounting friendly treatment. The swap will go through your profit and loss statement. It will be a mess. It will be volatile. I'm not going to help you. So now you start piecing a lot of stuff together. There is regulation in the US. For large banks, it's very tight. Liquidity coverage ratio, net stable funding ratio, stress tests, so on and so forth. Silicon Valley Bank didn't need to adhere to all of that. And that's bad. That's regulatory failure. from the regulator. I think they have underestimated the need to regulate small banks. But then the accounting rules that here I'm saying, which give wrong incentive schemes, are valid for all US banks, even the large ones, So that is another mistake. There is a regulatory problem. There is an accounting wrong incentive schemes. And this then leads to some problems that first will hit small regional banks, most and foremost. But now investors are asking themselves, have large US banks done their homework on interest rate risk management, or does this expand further? And then I'm going to stop now for a second.
Not only was the management running and gunning, but the regulators really should have been watching out for all this. One other item is that you said that the deposit base is easy to leave. And not only that, they're incentivized to leave because so little of the total deposit base was actually under FDIC insurance. And so you had the double whammy of I can move and I'm motivated to move.
This was the perfect storm, where you had a motivated depositor base that would move away. First, because if you now deposit money at a bank, you get almost nothing. But if you park money in T-bills, you get 5%. If you park money in a money market fund, you get 4.5% to 5%. So, well, the money incentive scheme is there already to take money away from banks. And then you have now a very risk-prone depositor base that can fly away. Now, this is a problem. This is a bad model from Silicon Valley Bank. I mean, very volatile funding base, terrible risk management. The other thing to add to that story is that Silicon Valley Bank also did a large amount of moral hazard in all of this, that it must have played a role. There are at least 2 to 3 instances where I can point to. First, the $250 billion limit to be exempt from tighter regulation. These guys have lobbied for 5 years to try and increase it. I mean, what does it say if your management lobbies to increase this regulatory limit, and then we find out you were running large, you were trying to exploit these regulatory loopholes as much as possible? It doesn't look great. Second, the hedges. So let me show you something, because we said that these guys didn't hedge, right? And they didn't. Now let me show you something even more scary. There you go. So help me out here. December 2021 balance sheet of, this is the 10K of Silicon Valley Bank. Interest rate swaps here. First of all, they put a note and they say, interest rate swaps are to manage the interest rate risk on our AFS securities portfolio. We enter into a pay fixed receive floating swap to hedge against the change in fair value. Wow, they know a lot about how this works, right? It's not like they don't know. They do know what an interest rate swap is for, and they have $11 billion of interest rate swaps on the balance sheet. Now, remember, the security portfolio is $120 billion. So this is not enough to hedge it, but they have some. I mean, it's not zero.
We know they were active.
Yeah, and they know what it is. They know what it is. Now, can you please help me look at what they did by December 2022? They took it off.
Active management.
So look, this is another signal, because the other thing is, if the portfolio shrinks, then maybe you say, okay, let me take off some hedges. But the portfolio went up between 2021 and 2022. This is 111. They bought more bonds and they took down the few hedges they had. I mean, guys, and then they booked a large proportion of the bonds here in held to maturity, 90 billion of those. So you know what interest rate swaps are for. You know that if you put bonds in held to maturity, you cannot hedge that. It's the accounting rules. You still buy a ludicrous amount of mortgage-backed securities in held to maturity where you cannot hedge that. You know that. And on top of it, you take down the few hedges that you already had. Your management lobbies to increase the cap for laxer regulation. Your CEO sells shares weeks before this drama happened. I mean, guys, there must have been some moral hazard at play here. and it makes the thing look very, very bad.
Yeah. Well, this argues a little bit that this should be a relatively isolated case. What is the implications? What are the implications you think for the regional banks?
Okay, this is an excellent question. And again, I share screen and then I stop sharing and then I share them again because I have supporting material for quite a lot of stuff. So broad banks, I'm now going to share with you a pretty interesting table. Can you see this table? Yeah? Okay.
Yes, we can.
So people are now asking, large banks. I mean, if a couple of small regional banks go down, it's bad, but it is terrible. If Citi, Wells Fargo, JP Morgan, I mean, if these guys are in trouble for the same reason, that's a problem. So what people are saying is, if banks can't hedge their held to maturity bond exposure because of the accounting issue, remember, we talked about this, the accounting rules for held to maturity bonds, to hedge them, they are not friendly. So if other banks have booked a lot of bonds in held to maturity, they cannot hedge it. And as interest rates have gone up rapidly, what about the losses in these held to maturity bond books? Okay, then I looked into the numbers. This is part of the story. So we'll talk about the overall interest rate risk story at a bank. These are the bond portfolios at banks. This is in percentage of total assets. And I want you to look at the numbers because you will see that most banks have investment portfolios between 10 and 25% of their assets, okay, roughly. Then you have Silicon Valley Bank at 55. So they had a ludicrous amount of bonds, okay? Other banks have 10 to 25. Charles Schwab is an interesting case. Here is the bank capital, and here are the unrealized losses. And then I want to compare, like, how much of these losses are in percentage of the bank's capital. So if the bank would be forced to liquidate all the bonds they have in held to maturity, if there was a big bank run and they had to sell all the bonds, what would be the losses? Well, Silicon Valley Bank, it wiped out all, right? We know it basically went down. You are looking at Charles Schwab, I know, but here my spreadsheet failed me. So the number here is 26, not 8, the bank capital, which means this number here is around 50%. But guys, we're still talking Bank of America and Charles Schwab at 50% of capital being wiped away. That's a lot. And then you're looking at JP Morgan, Citi at 10, 12, 25, still quite a hit. I mean, if a bank loses 20% of their capital, it's not small, it's quite a hit. This is what's making people doubt whether this is not only a problem of Silicon Valley Bank, but it's also a broader problem. Okay, I want to put some context. This is a relatively scary table, so let's put some context around this. First of all, two things. First, if you need to liquidate your held to maturity bonds, it means your deposits are flowing away. If your deposits are going away, you need to meet those deposits and you need some source of liquidity to be able to do so, right? So normally you need to liquidate your bonds. You can repo them out and get the funding, but it's only a temporary thing. If this deposits are gone for good, you need to sell. Now, the Federal Reserve has come out with a facility which basically allows something incredible, if you ask me. The Federal Reserve has said, ladies and gentlemen, these are treasuries, mortgage-backed securities that we trust. So what we're going to do is the following. You can post to the Fed all these bonds. You see these losses? Ignore them. You can give us the bonds at par, at notional value. 100 million you bought, it's now worth 70 market value. Don't worry, we'll consider it 100. Take the bond, pledge it to us. We'll give you funding for a year. Not for a month or two, for a year at pretty cheap levels. So the Federal Reserve is trying to backstop this by saying, if deposits fly away and you need a replacement for these deposits, don't sell the bonds. Don't hit your capital. Don't crystallize these losses. Give the bonds to us at full value. We'll fund you for a year at pretty decent rates. Okay, this is something to consider. It's important. The second thing is the deposit base of JP Morgan is not the deposit base of Silicon Valley Bank. I mean, these banks are subject to net stable funding ratios, all of them that you see in this table. So they must have long-term sticky funding on their balance sheet. They cannot have such a rapid bank run as Silicon Valley Bank had. Third point I want to come across with is this. and this is really important. It's a bit complex, but we need to talk about it. And I'm using now charts from Europe because I'm European, I'm Italian. I think my accent says a lot about it, but Europe does a lot of things in an optimal way, but on risk management, wow, I worked for a European bank for years. They suffocate you in regulation. So, and this is what they did. So a bank has interest rate risk, not only in their bond portfolio, but in the assets and in the liabilities all over the place. So they have loans, they have mortgages, they have bonds. On the liability side, they have long-term funding. They have sticky deposits. They also have a certain duration. So what I'm saying is a bank balance sheet is a complex animal of assets and liabilities that carry interest rate risks. Banks use swaps to try and mitigate these risks somehow. Okay, they do risk management. The ECB estimated for all European banks what is the duration gap between all assets and all liabilities. So let's stop focusing about only debt held to maturity bond book. Let's take the entire balance sheet of the bank, okay? It's the blue line. And yes, banks run positive risk duration gap. I mean, it's the business of a bank to borrow short and lend long. That's what it is, okay? So they do run it. They have interest rate derivatives, the yellow line, offsetting some of this net risk. The red line is the resulting net exposure. So yes, even at an aggregate level, banks are exposed to higher interest rates. The capital of the bank loses if interest rates go up. How much? Because this is the question we're asking ourselves. Is it big enough to bring down big banks? Is the problem big enough to bring down big banks? Go to the right. The European Central Bank estimated that a 200 basis point move in long-term interest rates, and we have had a 300, 350 move. So you need to take this number and multiply by 1.5. Wipes out 4% of capital of European banks. You remember this table? Even for large US banks, it was 12%, 15%, 20%. If you looked at only at the held to maturity losses, they would take out 10 to 20% of the capital. The central bank says, look at the entire balance sheet, look at the liabilities, look at the assets, look at the swaps, look at everything together, and it will wipe out on a 300 basis point move about 5 to 6% of capital. Now, it's not small, it's a hit, but the hysteria going on around here is probably a bit overblown. And I wanted to bring some quantitative assessment done from a regulator in Europe that has looked at the entirety of the balance sheet. And I'm going to say one thing more. JP Morgan in the US has estimated that 100 basis point move higher in interest rate wipes away roughly 2 billion of capital for the bank. Do you know what is the capital that JP Morgan has? $275 billion. Now, interest rates have moved up by 300, 400 basis points. So it's not 2 billion, it's maybe 10 billion of a hit. It's a big hit, but you're looking at 270 billion of capital, guys. Just breathe in, breathe out. That would be my my take for the time being. Although some regional, just to finish, some regional banks are much more in trouble. Their funding base is very volatile. Their exposure, idiosyncratically speaking, for that bank can be very large to interest rate risk. So the analysis needs to be done bank by bank if you want to understand where the risks lie. But if you think this is a systemic issue, then my take is I don't see the major evidence at the time being.
It seems that one of the loopholes about the solution this weekend that the Fed and the Treasury proposed was that we will lend you against a par against your securities, but your equity position is still damaged because you're taking a loan rather than an equity.
You're right. In principle, that's correct. What you say, this is a loan, it's funding, cheap funding against collateral valued at par. It's a great deal, but it's not equity. And the idea is that by filling this gap and calming markets down, and when people understand there is no bank run on JP Morgan, okay, when people understand that, then the fix would have worked because you have basically put a large band-aid that avoids banks having to sell the bonds from held to maturity and crystallizing the losses and taking the hit of capital and needing new capital, right? You want to avoid all this cascade. The Federal Reserve cannot show up and inject capital in banks. They can, but politically speaking, it's really bad looking. So I think they will be avoiding this as long as possible.
It was encouraging to see your analysis of the European banking system because while the markets are reacting today, it doesn't seem like that's a very legitimate reaction.
No, look, the market can stay rational much longer than you can stay solvent, somebody once said. And he's right, because fear drives, obviously, a lot of the initial reaction. It makes sense. Especially in Europe, there is a very large bank like Credit Suisse, which was already in trouble before, and then people like to extrapolate that this is going to bring it down, probably. And Credit Suisse is a very large bank. So look, if you look at the data and the analysis, of course, banks are damaged if interest rates go up very rapidly. I mean, corporates are damaged. The housing market is damaged. The entire system is built on credit, on leverage. So if credit and leverage become expensive all of a sudden, then clearly you're going to make some damage. I mean, that's undeniable. Here we're trying to discuss whether this is systemic banking crisis or not, and the evidence doesn't show that this is it. The evidence shows that this is going to be a blow to the equity position of some banks, and really, the magnitude can be materially different between a small bank which has used regulatory and accounting loopholes, has applied a large portion of moral hazard, and has a business model which is very, 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 very risky, and instead a large bank that is suffocated by regulation, so it can't even use any regulatory arbitrage. Maybe they use the accounting arbitrage we discussed before, but at the same time, they have a risk management that is much more advanced than Silicon Valley Bank. So they are mitigating some of the risks. They will also take a blow to the capital, much less than a regional bank. The risk of deposits flying is much less than a regional bank. And there is a Federal Reserve facility that basically applies a lot of cheap emergency funding if needed. So these are the facts. Can it get worse? Sure, it could. I mean, if all of a sudden we show up at the bank and get their money out and start buying T-bills instead, no bank can sustain large bank runs. Doesn't matter what the regulation is and how many liquid assets they have. If we all run at the bank all at once, then the bank has a problem. How close are we to that hysteria? I don't think we are close to that.
Let's talk about the Fed for a minute. You sent out a tweet last night that we agree with. There are a lot of people out there that say, "Oh boy, now the Fed has to respond to all of these threats to the system." And so they're gonna change their trajectory of tightening. I think this is going on with the Fed's thinking at this point.
Question. Okay, look, my mentor, when running together, he told me, Alf, it's not about what the Fed or policymakers should do. It's about what they will do. So that's what we are here to analyze. I'm not going to say what Powell should do, but I'm going to try to put myself in his shoes, apply his incentive schemes, and see what I would do if I were Powell. Yeah, that's the exercise that investors have to try to do here. Okay, so you have a couple of small banks going under and quite some stress in the market. You have inflation numbers being released yesterday, showing that core services ex housing, which is a lot of word to say the sticky part of the inflationary basket, is trending at 5% annualized. That's way north of your mandate. And over the last 3 to 6 months, showing no material improvements. You have the labor market printing 300,000 jobs a month, if you trust, let's say, only that data point, but still, it's not a recessionary labor market at all. So, you need to apply some pressure. You need to tighten. From a monetary policy standpoint, 5-7 days ago, you went to the Senate testimony and you said literally that if a recession is what we need to bring inflation down, you'll go for it. That's what Powell said when answering the questions from the senators. Okay, so the data in the meantime doesn't justify you. From a monetary policy perspective, not sticking to the same script. You should from a data perspective. Then you have this financial stress situation. What happens if you show up now and you say, Well, because of the nervousness, we are going to stop hiking. What is the message you send? You send a message where you say, I'm scared. I think this could turn out pretty ugly. So we're going to take a pause here and assess. You have designed the most friendly facility the Fed could design, Robert, without going into injecting capital. I mean, this is the cheapest funding ever at the cheapest, best condition you can ever design. You have already done that. And then you show up and you say, no hikes anymore. It means you're pretty stressed, right? It means you wanna take a breather here because you don't know what happens next. So you don't show confidence. And also you say, ladies and gentlemen, we're basically done with inflation trending at 5% still. I'm seeing it as power right now. The data doesn't justify you doing anything different that you told the Senate testimony you would do. So I'm afraid your hands are tied, Robert. You show up. If I were him, I would do 25 basis points because you didn't promise 50. You just said you're data dependent and you're going to be saying that data is coming, confirming that inflation doesn't slow down. So you need to slowly keep hiking. You need to slowly keep tight. And you're going to mention nothing. You are going to say some reassuring words on banks. You're going to be saying you have a facility in place that immunizes from everything. And you're going to be saying that the Fed applies monetary policy given inflation and growth and the labor market. And that's it. And you're not going to mention banks because the moment you say, we apply monetary policy based on what happens in the market will be saying, yay, I'm going to sell all the bank shares down so you can cut rates. That's what the market's going to be doing. So you want to regain control of the narrative if you're Powell. And right now you're at risk of losing it. If you hint that you are afraid, you might risk losing it completely. So I think you will stick to the script.
Yeah, I think the downside is not only is there a mandate for the Fed to be vigilant against inflation, that's what Powell has been saying. So you can't change the priority at this moment because you still have an inflation problem. And so what you can do, though, is use other tools, particularly your balance sheet, to address the skirmishes, the brush fires that happen. He said that things would break. We all know that things are going to break. This was one of the examples, and he showed you that he can put these little problems to rest, but he still has the priority. And what is interesting is that priority of keeping inflation down may wind up actually causing him to hold rates higher for longer because the tools he's using tend to be inflationary. If he's going to start expanding the balance sheet to put fires out, that can be inflationary. Certainly most people believe it is, and that would cause him to have to keep rates higher for longer, as he's been claiming.
So look, I think your assessment is right. And I think the Fed always ends up breaking something. History shows. The very nature of a monetary policy tightening from the Fed is that it happens late. It is not proactive, it is reactive in nature. When inflation picks up, you want to hike, and inflation is the most lagging indicator of the macro cycle. So if all other things are pointing down, inflation will take a while to move down, which means you will keep your policy tight for longer, trying to target the most lagging indicators of all. So the very definition of a Fed tightening cycle is something that always ends up breaking something. Now, I think if there's one thing that was already breaking and is likely to break is the housing market, Robert, rather than small regional banks. I mean, look, housing sales are down 40% year on year. So basically, the market is frozen. Sellers, for the time being, are not selling because they locked in a mortgage at 3% for 30 years. So why would you sell unless you're forced to sell? This is like families and domestic investors. Buyers are cut out of the market because they can't afford it. I mean, mortgage rates at 7%. In Atlanta, the median mortgage installment monthly to buy the median house in 2013 was $300. $300 a month, you would buy the median house in Atlanta. Today, it's $2,000. Is your salary in Atlanta sevenfold up in 10 years? No, it's not. It's not up 600-700%. Give me a break. So that means the affordability levels for buyers are terrible. So buyers are not buying, sellers are not selling. The market's frozen. What happens? Who blinks? That's the question. And I think we're starting to see who blinks, because Blackstone and KKR, the two largest real estate investors in the world, have gated redemptions from their real estate funds. What does this mean? This means they don't want investors to take away money from these funds, because if they do, it's the same problem as per banks. They need to liquidate the assets. They need to sell these offices, the stores, the house, the multifamily houses. Where are the buyers, Robert? Where are the buyers? So they don't want these outflows. It shows you how in precarious equilibrium the market is. And now we also got the first default on a CMBS, on a commercial mortgage-backed security property bond by Blackstone. $560 million. It's not a gigantic amount, but it shows you what happens if these offices and these stores are not delivering the cash flows that are needed to service the securities and to pay coupons to investors. The only thing you can do is sell the securities, and you find no buyers, and then you default. And between 2014 and 2021, institutional investors were looking for yield. There was no volatility, no credit spreads, QE, no inflation, yields were low. So a lot of banks, pension funds, asset managers, they ended up buying real estate leveraged vehicles, residential mortgage-backed securities, commercial mortgage-backed securities, leveraged loans, CLOs, so on and so forth. The structures were safer than 2007. Obviously, that was just ridiculous. But there are a lot of institutional investors that have invested in the asset class to try and generate returns. The family won't sell their house if they're not forced to because of the mortgage they have locked in. That's a different incentive scheme. The institutional investor, trust me, they will sell if their risk manager says so, or their investors on the back are demanding their money back. So the way I see it, the housing market was always going to be the thing that breaks, or one of the highest suspects to break. But I don't think that Silicon Valley Bank qualifies as the thing that breaks, that makes the Federal Reserve stop the hiking cycle.
To take risk assets off the table as attractive, what are the assets that are the attractive ones right now for an environment that we are just describing?
Oh God, this is a tough question. So let's say 6 months. It's tricky. 6 months ahead, I'm gonna say something very boring, which is you get paid 5% in T-bills. Sounds great. It's the liability of the government. It's not unsecured money. It's not money in a bank. It's a liability of the US government. Pays you 5%. Not too bad, I would say. And as long as Powell keeps policy that tight, it will keep you paying 5%, maybe a bit more if it keeps hiking rates. I mean, it's not too bad.
I think the only risk there is what inflation does in the next 6 months, and that's true. That's also not a bad bet. I don't know. It's 5%. It's probably about right.
All returns then need to be compared to inflation, and here you're starting from a risk-free 5%, which is not too bad, I would say, right? So I would say that is a chunky thing to have in the portfolio right now. Also because cash provides you with optionality. If there is really hysteria, if things really get massively shaken out, then you have an option. You have cash and you can deploy it to buy stuff at discount. Normally, you have to pay for this. I mean, in real terms, you had to pay quite a lot of money in the past, and now you have 5% T-bills with roughly 5% sticky inflation. So, you can have this cash, and even in real terms, as we speak, you don't get penalized for doing that. So I would say that is something you should have in your portfolio. Equities, I find it very hard, to be honest. I mean, I'm looking at credit drying up in the economy, all leading indicators pointing south, earnings per share being negative on a year-on-year basis. Credit remains tight for the economy. I can't be very positive, let's say, on equities right now as an asset class. Then you have bonds and precious metals, let's say, and the front end of the bond market will do what Powell says it should do, because they control basically rates, especially between 0 and 3 to 5 years. If he wants to keep tight, then you're going to lose money by buying front end bonds, because he's just going to drive rates higher and higher, and there is nothing you can do about it. The back end of the bond market instead is driven by other forces: flight to safety, inflation expectation, growth expectations. And I think Treasury is around 4%, 10 years, I would start buying some. So if you get backup once the negativity here maybe dissipates and monetary policy becomes against the focus of the market and yields maybe rise a little bit again, I think 4% 10-year Treasuries looks good. What I like, I think, is the Japanese yen, because in Japan, these guys are going to now, they've had a change of the guard at the Bank of Japan. There's a new governor, and he wants maybe to change a thing or two in Japan. Japanese investors are the biggest exporters of capital in the world. And when there is stress outside, they generally repatriate money back in the first place. That supports the yen. Now they have, I think, another incentive, which will be that domestically they will get a bit better yields in Japanese yen terms, because the Bank of Japan will change a bit their monetary policy towards a more hawkish stance. So they get a double whammy of incentive schemes to repatriate back in Japan, and that should support the Japanese yen. These are really the things. They are very defensive. I mean, you're talking cash, Japanese yen, bonds, if yields back up above 4%. This is nothing that sounds like, a very aggressive portfolio, but I don't see the setup, to be honest, to have a very aggressive portfolio at this stage.
Yep, that's it certainly feels that way. I guess, the bulls are hanging their hat on the idea that the Federal Reserve is going to have to start easing, and that we're going to have a collapse in inflation and economic activity, and that should be good for stocks. And it's a bit of a head scratcher.
Unfortunately, yes. It's to be honest, the uncertainty around is very, very big, both the monetary policy, on the path of inflation, on the path of the economy. Now, housing market problems, banking wobbles. There's a lot going on. Yeah, that's what I try to do at the Macro Compass. Make sure that I can use my experience and my data-driven macro work to help investors and people to navigate these markets. It's pretty tricky out there. Just do my best with hard work and see what happens.
Are there any deep questions that you're doing work on that will unlock new areas of valuable insight into markets?
You want to know a deep question that I'm working on? Look, one thing that I'm trying to ask myself is, has the pandemic changed something structurally in the economy? This is a question that is important because the pandemic has shown people that maybe before they were working for too little, they were using their free time, and they were, in some cases, not demanding enough. And some people have chosen to retire, and they haven't come back to the labor force at all. We're talking still about 600,000, 700,000, 800,000 people in America, almost 1 million as we speak. And does this suggest that something has structurally changed, that the labor force is scarcer than before, that labor supply is not as abundant as it was? Sum it up with, well, geopolitical wars, basically still running in the background, with onshoring rather than offshoring, because during the pandemic, you realize that having the on-time supply chain model where you completely rely on stuff coming from outside can be risky. So maybe you want to bring back some manufacturing, bring back some jobs. I'm trying to make some analysis on to what extent these undeniable changes are inflationary in nature. To what extent do they offset or more than offset these inflationary trends that remain in place? An aging population, technological advances, more debt, those things haven't changed. They've probably gotten a bit worse after the pandemic, if you ask me, or a bit stronger as an impulse. But now we have some offsetting forces on the other hand. So you have to try and balance those out, make an analysis to understand, has something changed on a net basis, and what do I do with my investments?
Awesome. That is definitely a big thought. Is this something that is permanent? And if it reverses, what causes the reversal? Very interesting. One thing that would cause the reversal would be a depletion of savings through stock market corrections and bonds and defaults and things like that in a recession.
Pretty much.
Well, Alf, this has been fantastic. Thank you so much for your time. I hope you've enjoyed it. I know that our listeners will value it and enjoy it as well.
Well, Brandon and Robert, it's been a pleasure to be here. And if people have enjoyed this chat and I want to know more about what I do in my work, they go on the macrocompass.com and they can find all that I do.
And we're going to be posting that on our website as well.
Thank you, Robert and Brandon. Very much appreciated. And I will see you guys again soon.
Great. Take care.